me see. I got a mic check, 1 2 1 2. I'm back. I know I said I was gonna come on live at 11. I'll probably still go live again later on too. But I figured I will have a little midday class. Why not? How y'all doing this evening? No sound detected. What? Okay, hold on. Okay, can y'all hear me now? Yo, can y'all hear me now? Mic check, mic check. Mic check, mic check. Can y'all hear me? Adrian, can you hear me? Mic check. Can I get a mic check? One more time. One more time. Can y'all hear me? I want to go over something I think is important. I think everybody, as an investor, needs to know, but you don't just come out the gate knowing this, right? People don't just know how to read a balance sheet when you first get started. Who in the chat, though? Who we got in the chat? Jay, what up? Mic check, 1 2 1 2. Let me turn my shit up a little bit more. Let me see. All right, y'all, while I'm yapping, I need y'all to tap the screen for me if you can hear me. Let me see. I'm going to check it out on another YouTube. I got another page. Oh, yeah, y'all can hear me. Okay, we good. Like I was saying. So, the balance sheet provides a snapshot, right? It provides a snapshot of a company's financial position at a specific time, ladies and gentlemen. It identifies the value of the company's assets and its liabilities, okay? What it owns versus what it owes. The difference between these two is the corporation's equity, aka net worth. I'm gonna say it again because I see we got some people just coming into y'all coming in back into class. So I'm gonna start over. We talking about the balance sheet of a business right now, of a company. Before you go to invest in them, sometimes you need to look at the balance sheet. How many of y'all bought stocks or bought shares of a company and you never looked at the balance sheet before? Miss Crystal, how you doing? Good evening. You might be the only one in here right now, Miss Crystal. Can I get a roll call? Everybody drop a W in the chat if you in class today. I just want to see how many people in here because TikTok be capped out sometime. Good evening. I figured it might be just you. Okay, we got one. It's all right though, Miss Crystal. I'm gonna give the class even if it ain't nobody in here but just you. You gonna be the only one today to learn how to read a balance sheet. So basically, what this is going to provide you a snapshot of a company's financial position at a specific time. Wesley, what's happening? So it's going to identify the value of the company's assets, what it owns, and its liabilities, what it owes. The difference between these two figures is the corporation's equity or their net worth. So now you never have to guess, what does net worth mean? What is equity? How much money they got left over? Okay? We need to know the value of the company's assets and its liabilities, and we need to know the difference between the two because that is what is the company's equity or their net worth. You understand? So although it is useful in determining a company's current value, the balance sheet cannot tell us whether the company's business is doing better or doing worse, right? It don't tell us we can't tell whether the business is improving or deteriorating. How about that? The balance sheet can only tell us where the company's business is right now. Okay? So the basic balance sheet equation can be expressed in two ways. For those that's just coming in, this is for educational purposes only. Welcome to the Ironworth Trade and Show. I'm your host, Coach Price. This is not financial advice. So, the balance sheet equation, you can look at it in two ways. Assets minus liabilities equals your net worth. If I got $100 million in assets, but I got $60 million in liabilities, then I got $40 million net worth. Okay? So we look at their assets, we look at their liabilities, we look at how it's been doing throughout time. Because remember, it's letting you know the balance sheet can only tell you where the company's business is right now, right? So that's why I pay attention to the balance sheet. It matters. Ladies and gentlemen, it matters. So I'm looking at NVIDIA and I see that they have $111 billion in total assets altogether. But total current assets, 80 billion. Total non-current assets, 31 billion. And we're going to go over these in a few. I just want to start with the basics. I'm going to start with the basics. I don't want to confuse you. Okay. So the second way you can look at it is assets equals liabilities plus your net worth. Okay. So 100 million in assets. And I got that from adding the liabilities plus my net worth. 100 million equals 60 million plus 40 million, which is assets equals liabilities plus net worth. Because remember, the other way I told you could look at it is assets minus liabilities equals net worth. If I got 100 million in assets, minus 40 million. No, I'm sorry. I said that all fucked up. So excuse me, y'all. I got 100 million in assets, right? And I subtract the 60 million that I got in liabilities and I only got 40 million left. That's my net worth, okay? I apologize. Pardon the body. Pardon the body. So several types of information is gathered together on the balance sheet, ladies and gentlemen. The assets. What did I do? Okay, yo, the assets, liabilities, and the net worth. This is all being recorded, right? So assets are divided into three categories. Pay attention. Current assets, right? We got current assets, you got fixed assets, and then you got other types of assets. But the current assets are this part right here where it says total current assets. Pay attention. This is cash and assets that may be easily converted to cash. Okay. Securities accounts receivable, accounts receivable. What else we got? Basically the company's inventory. These are examples of current assets, right? Then you got fixed assets. Fixed assets are assets that are difficult to liquidate, like real estate, furniture, equipment. These are all examples of fixed assets. If you are an entrepreneur, your business has total current assets and you got fixed assets too. Now you got some other type of assets that, like intangibles or goodwill. Okay, that category represents things that are difficult to value. Trademarks, copyrights, reputation, intellectual property. These are all examples in that category, ladies and gentlemen. Now, liabilities, right? Remember, assets is anything that put money in your pocket. A liability is anything that takes money out of your pocket. So a liability is divided into two categories. All right. We got current and long-term liabilities. Everybody got liabilities and assets. So I would hope. Because sometimes you wake up and you look up and like, damn, I don't have no assets. You might want to work on that. Because remember, your net worth is your assets minus your liabilities. Okay. If you got $100,000 in assets, but you got $60,000 in liabilities, then your net worth is 40K. You get what I'm saying? So you got to pay attention to your assets and your liabilities. The liabilities are divided into two categories, but we're not talking about for your personal balance sheet. We are speaking about businesses that you are looking to invest in. You want to look at their balance sheet. Okay? You want to take a look at their balance sheet. Any questions before I move on? Any questions? Okay, so check it out. So now current liabilities right here, we see total liabilities, total current liabilities, 18. So remember what I told y'all about how to calculate someone's balance. What is the balance sheet equation? The balance sheet equation would be assets minus liabilities equals net worth. Assets minus liabilities. Okay? That's how you can come up with a company's net worth. So we can see the current liabilities there. Those are liabilities that are due now or in the near future, right? Within 12 months. So we got current liabilities. Thank y'all for liking the live. I appreciate you so much. What happens is you push me out to a larger audience. It just gets me out there on the For You page. That's all it's for. It just tells the algorithm they liking this video. Let's show it to some more people. And I appreciate you for that. So we got, again, current liabilities. Those would include accrued wages, right? Define accrued. I know that's a big word. ACCRUED. Write that down. Okay? Accrued. Accrued. I'm gonna give you the technical definition so I don't remix it, because I'm known to remix it. All right, so accrued, of benefit or sum of money received or accumulated in regular or increasing amounts of time. All right, accrued. or it could be of a charge or cost relating to work done but not yet invoiced, made provisions for at the end of a financial period, accrue,
accrue,
okay, which is sums of money or benefits received by someone in regular or increasing amounts over time. And that is the case in what that's the one that we talking about right now. So accrued wages, accrued taxes, accounts payable, or interest payments. These are all liabilities. Your bills, right? Long-term liabilities are debts that will not be paid off in the near future. And for a corporation, this will normally be notes and bonds, right? Corporations owns, they invest in a lot of treasury notes and bonds. Now, the interest that is due in the next 12 months will also be reflected in the total current liabilities section whenever you're looking at a company's balance sheet. Are y'all with me? This is like a college course. If you need me to slow down, I will. But if you need the beginner's crash course or you want to start from ground zero, please inbox me and I'll slow everything down for you. But for now, just let me know if you got me. Let me know if y'all with me before I continue. At least you, Miss Crystal, you've been here from day one. Yeah, so the interest that's due in the next 12 months, that's going to show in the current liabilities part. But the principal is a long-term liability overall, right? So now, net worth. The net worth section has several components to it. See the total liabilities and shareholders' equity, total common shares outstanding, minority interest, total stockholders' equity, cash flow. I can come up here and see their cash flow, the net income, how much money they got coming in from damn near everything. You can come here and see financial forecast, net asset value. Okay, you can come here and see almost just about everything to do with the company. So there's no confusion on are they doing good or are they doing bad? You shouldn't ask nobody that. You should do something called due diligence. Okay, do some type of due diligence. Now, you got to look at the preferred stock. Where is it at? Balance sheet. We want to look at the preferred shares outstanding, which they're not really showing right now. But you want to look at the preferred stock, which is any funds received from the sale of preferred stock, right? Now you got common stock, which is the par value of the common stock, right? I know that's financial advisor talk. I'm not gonna get all into that right now with y'all, right? And then we got the capital in excess of par, which is monies received from the sale of common stock in excess of the par value. And then you got retained earnings, the earnings the company has made that have not been paid out as dividends. Okay? So you will get to see what a balance sheet is once you start to go and look in some of these companies, and that'll help you out. Let's look at another company real quick. I can see Tesla's balance sheet. You can see any company's balance sheet. So then there's a tremendous amount of information available from the balance sheet, okay? But there are only 4 ratios or numbers that are really being tested. And it's the working capital, the current ratio is something called a debt ratio. And there is something called an asset test ratio. I know it sounds crazy, but that's a measure of a corporation's liquidity. They calculate that by adding cash equivalents, notes receivable, accounts receivable, but not the inventory. Then they divide the result by the total current liabilities. It's a lot that goes into calculating whether, it's a lot more that goes into whether a company doing good or not. You don't just look at the price and look at the stock price and that determines it. No. So, the most common measure of long term liquidity is the debt ratio or the debt to equity. Pay attention to every single piece of information. This is where you really fully nerd the fuck out as an investor. As a trader too sometimes, because you trade in the company a lot of, I mean, if you know something, I saw something in GoPro that nobody saw because they was looking at the balance sheets and they ran the other direction. They saw the balance sheet on GoPro and ran the other direction. There it is, debt to asset. So that is this orange dotted line. All right. So the debt ratio is a measure of how a corporation's net worth is derived from long-term debt. This is Webull. I'm just on the web version instead of the desktop version. Okay, and I'm just showing you a picture next to it. Yeah, this is on my desktop. I'm just showing you a picture next to it. Yeah, see, I'm fucking up now. So let me let me put this back. But I know it's a bit like hard to see. So let me see if I can make it easier to see. I apologize for that. And let me send this forward. There we go. All right. It should be a bit better. How is that? Is that better? Now, the higher the debt ratio, the less long term liquidity a company got. The income statement right here, where it say income statement, right? Now, the income statement, this is also called a profit and loss statement or a P&L. You're good. Just wanted to know from my notes. And yep, better. Okay, good, Miss Crystal. I'm glad you taking notes. I value it. You know, I value it. Let's see. We got two new followers. This is a small class, but it's okay. That's why I really don't go live during the daytime. I don't get the same results I get in the nighttime. Nighttime I go live, it's thousands of people that come in from California, New York, Texas, Georgia, everywhere. Even Canada and Australia. But it's alright though. Maybe the quality is in the afternoon and all the noise. Fuck, I ain't worried about the noise. You feel me? 2 out of 8 people is better than 10 out of 1,000. Because it'd be probably like 10 followers or 10 people that's listening. But back to class. The income statement, right? This is going to summarize a company's revenues and expenses for a fiscal period. What up, Swan? If you ever, what up, y'all? If y'all ever opened up a business before, right? Your tax year, they call it a fiscal year, right? It's a business year, and it's not necessarily measured from January 1st to December 31st. Okay, it's sometimes whenever tax time start, all the way to the, when they start up again, or it could be whenever you make your fiscal year. So companies have different fiscal years. Okay, so anyways, a fiscal period is usually 1/4 of the year, year to date, or the full year whenever you're looking at a balance income statement. So the income statement compares revenue with cost and expenses during the period. During that period, 2024 net income, and it's measured by the billions. That's 2 billion, 2.33, down 70% of year over the year. That's what YOY mean. I might be wrong on that. Year on year or year over year. Which one is it? I know Swan might know. Yeah, it might be year over year if I'm not mistaken. But I can come here and look at it on the annual level. Nonetheless, you get to see the net income which is shown by the blue, and then the yellow dotted line is showing you whether it's up or down over the year over year for sure. Okay, cool. So the income statement is going to compare revenue with cost and expenses during that period. It's going to reflect the business activity over a specific time period. Now, I like to use, not even just me, this is what fundamental analysts use. Everybody use income if you're doing due diligence, but I like to use the income statement to judge the efficiency of a company's operation and its profitability. You hear me? Operating income is sometimes referred to as earnings before interest and taxes, aka EBIT. They might call it EBIT. You heard of debit? This shit called EBIT. EBIT. Earnings before interest and taxes. Okay, or earnings before interest, taxes, depreciation, amortization. Okay. Now, the components of an income statement, they looking at the cost of goods, look at the revenue, operating income, net income. But yeah, they're looking at the cost of goods that has been sold, the operating cost, the operating profit, the non-operating income. They're looking at all of it. Make sure I'm on the right thing. Invest in finance. Because some of this can be confusing when you're new to it, and you like y'all probably some people skip right over this shit. Here we go. EBIT. Remember I was just telling y'all about the EBIT? All this information is here. It'd be right here under your fingertips. But it's like having somebody to kind of sit down with you and break it, explain it. That's the hard part. You know, finding somebody that got time for you. You feel me? But I had a pretty good day in the market, so I'm like, I got time. I give back to the community by teaching. That's why we here right now. Now, the components of an income statement is the operating profit, the operating income, which is, again, the earnings before interest and taxes. Interest expenses, taxable income, taxes, preferred dividends, common dividends, retained earnings. They looking at all of that shit is being taken into account. Several components. Now, it's two calculations that y'all should pay attention to from the income statement, which is the earnings per share. You're going to always see the earnings per share. Where we at? EPS. I can pick revenue. I can pick EBIT that I was just telling y'all about, or the net income. I'm going to pick EPS. But I could also look at the PE ratio to find out if a company is doing good. I want to know, what is the PE at? Here we go, right here. PE. PE. TTM trailing 12 month. I don't. A lot of this shit I remembered on accident. I promise you, I don't just got. I got selective memory. I don't just get to remember the shit. I promise you, I will set my wallet down while I pull out my ID. I could be in the convenience store, pull out my ID, use it, set my wallet down, and drive off and left my damn wallet at the gas station. I could do that and forget where I put my wallet at. But I can remember what the fuck TTM stand for. After, it's just weird. A lot of this stuff I remember from my first year of studying because it was fun. If you're not having fun while you learning, you're not gonna soak that shit up. If you're not interested, like right now, if you super bored, like if you are bored right now, you're not gonna learn. You're not having no fun. Tell me what you need. You want me to cut some music on or something? What you need, do whatever you need to do to get comfortable. Ask the question, say, hey bro, I ain't understand shit you just said, so I can simplify it. Okay? But assuming you understand what I'm saying, the EPS is calculated by dividing the earnings available to the common shareholder, which is you and I, right? Earnings, right? By the number of outstanding shares. The PE ratio, okay? is a measure of the amount of earnings a company can make compared with its current market value. CMV, or basically the stock's price. So the formula for the PE ratios is the current market value right by the PE ratios, by earnings per share. That equals the PE ratio expressed as a number. So let's say, what's this, Tesla, they got earnings. Let's just pretend for a hypothetical reason that they got earnings of 20 million, and then they didn't have 10 million outstanding shares. So they have a current market value of, let's say they got a current market right now is 408. In order for us to calculate the earnings per share, it will be the earnings divided by the outstanding shares. 20 million divided by 2. No, I'm sorry, 20 million divided by 10 million. Shit. What kind of kush is that? It says how to read a balance sheet. I've never heard of that kind of kush before. It says Tesla. You feel me? It's cushion. It's cushion. Creative art space. You nosy son of a gun. You all right? So look. Again, the earnings per share is the earnings divided by the outstanding shares. That's how you come up with the PE ratio. That's how they came up with this PE. For them, it's 408, but the outstanding shares, it says shares out. Do y'all see that? I mean, I know it's kind of hard to see. Matter of fact, I got it covered up by the damn picture, so let me move the picture. I've been talking about it this whole time and forgot y'all can't even really see it, so let me move this. It's right here. And I got to it by, and you can get to it on your phone. It don't matter where you're looking at it from. What you can do is bring out the key statistics. You want the key statistics. Let's move this to the top. I want the key statistics, though. I can see the market cap, how much they giving out for dividends, the outstanding shares, 3.75 billion outstanding shares. PE ratio equals the current market value divided by the earnings per share. Ladies and gentlemen, it's not complicated. But if you really can grasp this shit, I'm gonna tell you like a lady once told me, you should be a financial advisor. You should be a financial advisor if you could understand this shit. If not, it might be in your best interest to go and speak to a professional instead of just throwing your money at the fucking wall. You understand? So now I'm gonna ask y'all some questions to see if y'all been paying attention. Profits that are not distributed to shareholders are called what? Retained earnings. Earnings that are available to us, not necessarily us, but to the common shareholder, right? But not distributed to them, are retained by the company. Those are called retained earnings. Okay. So can y'all tell me what is not a measure of short-term liquidity? Is working capital a measure of short-term liquidity? Is debt ratio a measure of short-term liquidity? Is current ratio a measure of short-term liquidity, or is debt ratio a measure of short-term liquidity? Working capital, current ratio, debt ratio, or asset ratio? Basically, it's debt ratio, okay? The debt ratio is a measure of long-term liquidity The other ones that I named are all short-term liquidity calculations. Some of us have no fucking idea whether a company is if they got liquidity in it or not. So a company's earnings can be found by following which of the reports that I told y'all. The income sheet, the income statement, the balance sheet, the general ledger, or the trade blotter. Which one? Like, what the fuck is a trade blotter? The income statement, ladies and gentlemen. I ain't giving y'all time to answer. The income statement. Earnings are found on the income statement. The balance sheet has assets and liabilities. Okay? You understand? All right. I think y'all get the gist of it. Let's see. I'm going to keep it short, so I appreciate y'all for coming to class. I'll be back at 11 p.m. today. Yeah, until then, enjoy the rest of y'all day. I'm going to have this uploaded on YouTube if you caught the end of it, but this has pretty much been about how to read a balance sheet, and so you won't be confused when you're looking up a company doing some due diligence. And I appreciate y'all for tuning in. I ain't going to make this live very long. If y'all new here, hit the follow button so you don't miss another live stream. Ali L, thank you. Every time you come through, you show love. I appreciate it so much. Let me see, where is it? There we go. Oh, you more than welcome, Miss Crystal. Thank you for tuning in. I appreciate you. I appreciate you. You are appreciated. Robin Hood was in a Head and Shoulders. This look like a Head and Shoulders. If it get to 85, oh yeah, this is a big ass time frame though. But this was the neckline. This is resistance. This is the neckline. Monique, Nebu Goddess, hello. How you doing? How you doing? Thank you for pulling up. It's a gap from 79 to 85. Nice little fair value gap. It's at what, 79. So yeah, about 80 as an entry. Yeah. Risking 2% to make 6%. That's that 1 to 3 ratio. But that's the trade I take right there. If it can get to 80 this week, that's what I'm looking to do. Doo 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 doo. Y'all know the rest. Y'all know how the song go. Cause this the gap that I'm looking for to feel. It don't have to feel it, you know what I'm saying? But it's a strong level of support down here, buddy. Price was trading on this same level last year in June. It was at this level in June before it took up, went up, shot up to $153 from that level. Can you dig it? Can you dig it? See, let's look at it on a smaller time frame. So yeah, I want the price to get a little bit over into the gap. It's in the gap at $80. It's in the gap. It's in the gap at $80. But look, I got this shit set up all type of wrong. Hold on. This shit set up wrong. Yeah, right there. This is more realistic right here. I don't even. I won't. I don't have to risk a whole 1%. But yeah, I'll risk 1%. Yeah. So this is the trade. What up, baby T? What's happening? So this is the trade. And once this is not financial advice. This is just me showing you how I would. This is called a predefined stop loss. Okay. I'm already. This is predefined risk. I'm already knowing how much I'm gonna risk, and it's telling you here I'm gonna risk 1%. So it depends on how much your account is. This could be $75. This could be 750. Some folks is 7,500. I hope it's not, but whatever. In this case, 1%, and the target amount 6%. So that's really even more. That's the third target. My first take profit target will be in the middle of this gap. Right? I'll show you where. About right here. All bullshit aside, I'm taking profit right here because that's my rule. I'm gonna sell some of the contracts here, and I might sell some of them here, and the rest of them I'm gonna leave a runner. You don't runner, you don't track star. Ooh 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 ooh. Yeah, I'm gonna get out up in that area just to be more realistic though. You know, we're not greedy. Don't get caught with your hand in the cookie jar. Now, when the price, I just told this to the class earlier today. Once the price, first of all, I wouldn't enter the trade until it gets to 80 because I wanted to actually be in the gap. I wanted to stay above 82. I don't want to see it just get above 80 and then fall back below it like it got to 78 here and then drop below it. I wanted to do what it did here when it got to 78 and it went above it and stayed above it. That's a good sign. That's called waiting for confirmation. So I want the price to come. This is not a real trade. This is just me showing you using a tool called short position, long position, where you can pretty much map out the trade before you even get in the shit. You shouldn't just be getting in trades, man, without knowing what you're gonna do before you even get there. Okay. The reason why I'm taking the trade, I'll zoom out again and show you what brought this idea about. This big ass gap on the 4-hour time frame is there as well on the daily time frame. It's there on the 30-minute time frame. Where is it at? Right here. See? So I'm seeing it across multiple time frames. If the price, this is Robinhood too. So I think Robinhood was in like a head and shoulders pattern. So let's say it gets up there to that level and it fails to break above $80 and stay above 80, then I think it's gonna go ahead and continue to come down because there's a lot of gaps. A lot of gaps. Hell, there's a lot of gaps here. This one down here. If it break below $70 though, 65 will be the next level. And then timber, I don't know. I don't ever see Robinhood being $20 again. But just to show you something that's just to wake you up real quick, let me show you something real quick just to wake you up. When I go to a 1-year time frame and you look in 2025, you could have bought Robinhood for $29 a share. You could have bought Robinhood for $29 a share. One day in the future, you're going to look back and be like, I can't believe I didn't get no shares that year. It's a lot of companies you're going to look back and be like, damn, I can't believe I ain't buy none. What was I doing? You was shopping. Women be shopping. No, I'm just talking shit. Everybody be shopping, but y'all know what I'm saying though. All the money going to y'all ladies. Y'all outlive us men anyway. So y'all gonna be the richest on the planet real soon. Invest it. I'm trying to be y'all financial advisor in the future. I ain't got time to be playing out here playing with nobody. I'm gonna make sure I am teaching as much as I possibly can. Sisters, aunties, mothers, grandmothers, daughters, you name them. I'm teaching everybody. All right, any questions, y'all, before I cut out? I wasn't even supposed to do all that. I just did that because, you know, I'm really about to be done looking at the chart for till tomorrow or till later on tonight. Big gap here too. Thank you for the gifts, Chaos. I appreciate y'all. Y'all the best. Hey, join the community. If y'all not in the Discord, hit the link in the bio. You don't have to pay for the premium. Join the free side. I still want you there. I want y'all in the Discord. I'm not like them other guys. Come on in. As long as you not dry. No dry people. If you got that Eeyore off Winnie the Pooh energy, keep that shit over there. Keep that shit. You keep that shit over there. Alright, y'all. Let me go ahead and cut out. I ain't got nothing else to say.